Hey, what's going on, best ever listeners? This is your host, John Casman, and we are here for Multifamily Mastery. Today's guest is a great one. We're going to be talking to Chris Streit. Chris, how are you today?
Doing great, John. Thank you so much for having me on.
Yeah, absolutely, man. Listen, it's great to have you on. And before we jump into Chris and his story, I want to make sure all of you are connected with me. You can follow me on LinkedIn. If you're active on LinkedIn, just go to John Casman. You can find me there. And also make sure you're active in joining our best ever CRE community. If you're not, you're missing out. Great conversations taking place. And more importantly, it's a great way to engage with other hosts and our listeners. So make sure you join that community. We'll put a link to that in the show notes. Chris, why don't you give our listeners a little bit about who you are? Take 1 to 2 minutes and give us some of your background.
Sure. So, Chris Streit, my background is in tax and specifically the specialty side of tax. So not the broad, all-encompassing tax pieces, but very unique pieces of the tax code. Been in the tax game since about 20 years ago. State and local, and then now in federal. And what my firm does, we are a firm who specializes specifically in cost segregation and 1245 exchange, which primarily supports the real estate investing community. And as we talk about commercial real estate, multifamily, we see some of the largest opportunities there. So my firm that I lead, we are a little over 80 folks in just south of Salt Lake City, Utah. We only do one thing, but we make sure we do it really well and better than everybody else. And when we say better, we mean more savings identified for clients, more cash in their pockets. And then, of course, pairing with that, maximum defensibility with the IRS. All the money in the world can't save you from a really angry IRS agent. So we make sure you get your money and stay on the right side of that relationship as well.
Hey, Chris. We like people like you, right? I mean, ultimately it comes down to keeping more of our own money and having great tax strategy and a great tax strategist on your team's a part of it, but also the ability to execute some of those great tax strategies. You mentioned you guys focus on more specialty tax, both at the federal, state, and local level. I should say both, but at all three levels. Sounds like you added federal more recently. And you mentioned helping folks specifically when it comes to cost segregation. Did I hear you say 1245?
Yeah, 1245 exchange. So that's
all right.
That's
our listeners are probably familiar with the 1031 exchange, but the 1245 exchange might be a little different and new. So you got to break that down for us.
Definitely will. 1245 exchange comes in specifically when you are selling a property. One of the things that cost segregation provides, or the primary thing it provides, is figuring out which assets are what. And when you say what's what, the IRS looks at it in terms of 1250 assets, which are structural assets, and 1245 assets, which are non-structural, your personal property and your land improvements. Those are the things that you accelerate depreciation on. Now, as a result of that, you get all this cash from the IRS. You basically get a 0% loan from the federal government. In doing that, you can do a lot with that money. You can pay off debt, you can make improvements, which you can also perform a cost segregation on the improvements. Or you could just go invest it in a risk-free bond just to get a return. But the key thing is you're getting a time value of money that real estate investors, that's the only reason they're in real estate, is to maximize the time value of money, present value, future cash flows. Now, when you sell that property, if you're not doing a 1031 exchange, you do owe something called depreciation recapture, which basically what that is the amount that the IRS gave you and accelerated depreciation. You have to give that depreciation back. Oftentimes we don't realize that. Oftentimes also people sometimes say, I'm not going to do a cost segregation because I'm worried about recapture 2 years down, which we can talk into a little bit more, John. That's already a fallacy depending on the size of the building or the basis you have in it. A 1245 exchange revalues the assets of your personal property. So if you think about what happens in real estate, the land value goes up, the structure value goes up. Does the value of the carpet in that building go up? 100% not. The challenge is you have to prove the fair market value to the IRS. That's one of the services that we provide. We go in and we assess what the current real-time value of every single personal property asset is, revalue it in the degree that it's obsolete. It is no longer eligible for recapture, providing permanent savings to clients. The reason it's not that well known or that well done is because it is incredibly time consuming to do. You can imagine going in and taking a multifamily unit that has 250 doors, go price every single microwave, every single piece of carpet, cabinetry, all those things that there's not an active market in. It's something we've now paid a lot of money for in technology investment, but also in third-party appraisal data. So we can very quickly see, what is a 4-year-old microwave worth? What is 9-year-old carpet worth? It is a permanent savings tool that when somebody sells, it's typically found money, but it also helps improve the ROI of the cash-on-cash return for investors.
Yeah, you asked the next question I was going to ask is, why have we not heard more about this? And you just hit at it, right? So it's very costly to do. So that's one of the reasons you haven't heard more about it. On top of that, the next natural question for me is, well, what are we likely to see on this, right? If you're going to go and spend that money and take that time, how much are you looking at in savings? Can you give us maybe some context or an example as a case study as far as how much you could save by using that 1245 exchange?
Absolutely. And all my case studies that I have to just point to this year, it turns out they're all just multifamily ones as well. So it works out really nicely for the podcast. And it was not done by intention. It just happened that way. So what we're able to make it work, because just to give a little bit more story on 1245 exchange, about 10 years ago, we began doing it. And I need to take one more step back. We exist as a business because we're the back office for about 11,000 CPAs across the country. We don't do the entire tax planning process. We do this one thing really well because you have to know construction and tax. That's typically not something a CPA has. They don't have the construction side, they have the tax side. We have both. So when they need a cost segregation, they call us, we prepare it, we give it to them, and we've become the easy button for the CPA for their clients. One of our biggest customers, the top 100 CPA in the country, as measured by revenue, they said, we need you to revalue our clients' assets at the time of sale so we can help mitigate recapture. And they basically started to coach us into the process, and we started doing it, and we were losing money on it because it took so much time to get the data. We had to go find third-party transactions for those microwave buys and sales out there in the market. And as a result, we did it because we got so much cost segregation work from them that we had to do it just to maintain the business. Well, we did put a lot of capital expenditure into the technology, millions of dollars, and paid a lot of money for the appraisals, but we've effectively democratized that expense to now offer it to every single client, and we've trademarked 1245 exchange. So as a result, when we started getting into a few case studies, the investment required is extremely small compared to the permanent savings you're going to get. So one example that I have, it was a multifamily. If you're listening and you're from Texas, you know Salina, Texas really well. It's a big growing area here in the DFW Metroplex. It was a $36 million basis, 2.5-year hold period. So I'm sure, like a lot of your listeners, John, a lot of multifamily folks might be building from the ground up to develop and get to about 95% occupancy. Once they're there, the 2.5, 3 years later, they sell the property. This particular client was not doing cost segregation because 2.5 years from now, they're going to have to pay the money back. So to start, we explained to him, well, with the cost segregation, we were able to generate about $2 million in additional cash benefit in year one. $2 million. So the risk-free rate of return is $90,000 a year. So it's a very, very easy thing to say, all right, I should do this depending on how much it costs. It cost about $14,000 to do it. So for 2.5 years, you're looking at $220,000 in risk-free interest at a cost of, say, $14,000. Now, the key thing that was prohibiting the cost segregation was just the thought of having to repay the money. I think this is a principled item. I don't want to repay anything. But in the process of doing that, at the 1245 exchange, what we did is go in and revalue all the assets 2.5 years later at the time of sale. And the way to think about what's happening between 1245 property and 1250 property is the 1250, think slab, think cement. Think for 1250, think carpet for 1245. The cement begins to absorb that carpet. It becomes one with the structure, the more obsolete it becomes. So in that moment, we were able to determine the 1245 assets, how much they are obsolete, and then shift them to the 1250 property. And in this specific instance, with a basis of 36 million, but they were selling for 43 million, we were able to shift more to the long-term capital gain because it adjusted the basis of the property by revaluing those 1245 assets that are now obsolete. And in this specific instance, we saved this client $1,005,000 in less recapture they had to pay by revaluing these assets and moving them to 1250 property. Our fee for that, $30,000. So in the end, the net position after interest made and permanent tax savings was $1 million, essentially, over a 2.5 year hold period. When you think about their cash on cash return, I didn't get to see the K1. I didn't see the information back to the investors. Not sure what their leverage looked like, but I know we improved it substantially.
So that's obviously a great example, right? When you talk about a new development there, you can take a look at the 2.5 year hold, $36 million project sold for $43 million, basically a net return to those investors, and doing this 1245 around $1 million. What does that look like on a smaller scale? And I guess a different way of asking that question is, at what point should our listeners be asking themselves about a 1245 exchange? Is it based on the dollar amount? Is it based on the number of units? Like, at what point should we start to explore looking into this?
Sure. So when to start to look at this, it really goes down to the lowest level, especially now that we have 100% bonus depreciation now made permanent with the One Big Beautiful Bill. So what it begins with is to say, does cost segregation make sense? Because you can't do a 1245 exchange without a cost segregation. So it does begin with that. Did I do a cost segregation? And if I didn't, if I'm about to sell, should I do one right before I sell it? From a value standpoint, without a bonus depreciation world at 100% permanently, I would say somewhere around $400,000 in basis would be your floor. With a bonus depreciation world, you're talking about values of $150,000, $200,000 in basis, where it might make a lot of sense to do a cost segregation. Then if you're selling the property 4, 5, 7, 8, 9, 10 years later, then that's where you would say, okay, I should now lock this in with a 1245 exchange. But what's really beautiful about the 1245 exchanges, before you do a cost segregation on a property you already own or are buying right now, you could say, well, I might want to sell this in 4 years, or I'm planning to sell it for 4 years. What would be the impact of the 1245 exchange? So the ones that I would roll out, if you do have any properties that are, say, under 150,000 in basis, and the basis is the acquisition price minus the land, those are going to be borderline. But anything above that, I would say it's fair game, and it's always worth looking into to see if it would work.
And when you're saying basis, you mean the total purchase price, not like per unit or anything like that, right?
Right. Total purchase price minus land. So
Okay.
One of the ones that have been the most interesting is we've been doing these on Airbnbs, single family residential homes that somebody paid $260,000 for. The cost seg does generate a $65,000 deduction. So if you're in the highest tax bracket, you're talking about $20,000. And then when you go to sell it, permanent tax savings of, say, $12,000. Fee to do it's $1,500 because it's a small property with not much assets. You net out $11,500 in the 1245 exchange, and you had $25,000 extra in cash from the cost segregation that you could have went and bought new appliances for, or bought a new property for if you wanted to.
Yeah. So you may or may not know the ballpark, but I'll ask the question either way. But let's just say, hey, you buy a property for, say, $10 million. You go out, you do a cost seg. Rule of thumb, general ballpark numbers as best you can. What are you looking at as far as maybe some of the benefits or savings by doing that 1245?
So for 10 million, a couple of things that happen on it. First is how much bonus depreciation did they take? And for just for your listeners who, I imagine everybody in this podcast has been glued to see what happens with bonus depreciation. But the more depreciation you take up front, the more you will owe back when you sell. So that is a factor that does go into it. But say ballparking 10 million, let's call it a multifamily unit, which we know will have a lot of improvements. The cost seg is probably going to generate around somewhere between a $3 to $4 million deduction. So you're talking about $1 million to $1.1 million in a cash tax benefit now. But that deduction that you took of, call it $3 to $4 million, if you hold that property for 4 to 6 years, you're probably going to see a benefit somewhere in the range of $100,000 to $250,000 would be my estimate. It's going to could be contingent upon the hold period, how much bonus was taken, and then how much improvements were at the property itself. How many short life assets are we going to be able to determine have a percentage that's obsolete and fair market value less than what you paid for them? But $150,000 to $250,000, the fee to do it might be $8,000 to $12,000.
Got it. So for clarity, in that example, we use just rough numbers. Obviously, please don't, hold Chris's feet to the fire on this. But what we gave was around a $10 million property. Maybe you take $3 to $4 million in the bonus depreciation there in the cost seg. And through that, when you come back with this 1245, you could be looking at somewhere between, low $100,000, maybe up to $250,000, somewhere in that range with the savings you would get. And that net fee to you might be somewhere in the, let's call it $15,000 to $20,000 range. So, still can make 80, 6 figures on something like this. So it still is worthwhile to at least look into, if this is, a rough scenario or close to what you're looking at.
Yeah, absolutely. And what I would say too is feel free to bring it up to your CPA. What your CPA is going to say, oh yeah, I guess that makes sense, but you need to have somebody crazy enough to go in and value all your personal property.
And you're the crazy one.
Yes, I'm the crazy one.
There you go. Hey, Chris, with that said, with the 1245, we talked about the numbers and the cost. What about the time frame? Because most people, they go to sell, they're thinking about whether or not they want to do a 1031. They're probably not thinking about 1245. Is that something that needs to be done before you close on the property, or is that something that can be done post closing?
So the benefit of this is it could be done post-closing so long as they already had a cost segregation performed. And the cost segregation could be performed by anybody, because what a segregation does, in addition to give you a lot of money, is it segregates the assets from, you start off with a big hunk of meat and it just chops up the meat. And that way you can value it separately. So they could do it before, they could start to assess what the value is well before the sale. But could do it after the sale. Oftentimes people associate this with the purchase price allocation, where you're figuring out specifically what you're selling to the buyer. Completely different. It's a one-sided element just between you and the IRS, and it could be done after. The only time I would say really do it before or at closing is if you're dealing with somebody who did not do a cost segregation, because you can't do a 1245 exchange. So before it's sold, you would need to have somebody go in and, if you will, segregate, chop up the meat and do the segregation before the property is sold and they no longer have access to it. Then the 1245 exchange is done simultaneously to the cost segregation. And the time period to do a 1245 exchange is between 1 to 2 weeks to value the assets and produce the final report and produce the document needed for the CPA to prepare the final taxes. Cost segregations also, they typically take 2 to 4 weeks, but if they're being done in tandem, you could knock them all out in 2 to 3 weeks' time.
There you go. So assuming you do have a cost segregation, what's the time frame or the limit to get the 1245 done?
1 to 2 weeks.
So it's got to be 1 to 2 weeks post close to get that done.
Yes. Yes. And if you're already in the process of closing and you already have enough of the detail about what you will be selling it for, or you're 4 months away and you even have it listed right now and think it's going to be within a range, you can actually give a benefit analysis to show here's what it's going to be based on what you sell, with a 99.99% degree of certainty, because the only uncertain part, obviously, is what it's ultimately going to sell for. But if you have a ballpark range and you already have all the assets segregated, you can begin the valuation process and figure out, okay, when you sell, here's the benefit. It won't be a surprise where it's like, oh, I'm sorry, it's 50% less. That just doesn't happen. If you have the assets listed, you know what you can do.
Yeah, that's fascinating stuff, man. So I want to move on from this. This is a great concept. If you want to learn more, reach out to Chris and his team, right? So this is what we have these conversations for. Please check it out. Let's have a conversation. Go to the Best Ever CRE community and start posting about this. Curious if other folks are doing this now, leveraging the strategy. If so, talk about what you've saved. I would love to learn a little bit more about what you all are doing in this space. Chris, obviously from a tax standpoint, that's one strategy. What are some other strategies that you and your team help other investors use to save and reduce their tax obligations?
So I would say cost segregation is one of the larger ones. And I think the key thing with cost segregation, just to give everybody visibility into what's happening in the market, because I do believe a lot of your listeners have a good familiarity with it, but might not understand the scope of the market. And there's a lot that's changed. Obviously, it's grown and it's matured a little bit more. You've had a lot of pop-ups that spend a lot on SEO and just produce reports in 5 minutes. But you also have probably the most interesting IRS dichotomy we've had in our lifetime, from the end of 2024 to the change in administration in 2025. Because cost segregation, obviously, I think, and I'm biased, so I will go ahead and say I'm biased because I have a cost segregation firm. There are very few instances, unless entity-wise it's prohibitive, but financially, if you're holding it for a year today, it seems like it makes most of this. It makes sense most of the time. At 1 year and a day of a hold period, as long as the basis isn't too low. But what I think where we fit in the most, and in terms of value we provide, and what we're providing to investors and recommending investors look at heavily if they are doing this, is savings. The question should all be asked, savings at what cost? And not cost of expense to do it, but cost to my reputation with the IRS. And just the evolution of what's been happening in the IRS. So for those of you that were aware, or not aware, if you're not aware, it means you had the good fortune of never being audited. But for those that may have been, you've seen this. So as 2024 came to an end, we saw the most audits we had ever seen. And it's not cost segregations getting audited. It's just we could see taxpayers getting audited, and they were part of the scope. We do anywhere between 5,000 to 6,000 cost segregations a year. We typically see about 3 audits. Last year, we saw 12. But when 2025 turned around, that number went to 5 quickly when the cost-cutting measures took in and there were rifts at the IRS. But the big thing that I've seen change, and this is more of a tax element and a CPA element. For those of you who aren't aware, there's a massive shortage of CPAs. They're retiring and they're not being filled in. There's a massive shortage of cost segregation people not being filled in. There's a bigger shortage of people who want to be IRS agents. It's not something you tell your kindergarten teacher you dream to be one day. It just doesn't happen. So they're having to pull from a talent pool that really isn't that excited about the job, also isn't that informed with the tax code. And what we saw happening was some of the questions that were being asked, you could tell there was a lack of sophistication. All this preamble to say is that they're setting up really simple rules to say yes, no, pass, fail, versus debating you on whether or not something is a short life or a long life asset. So in terms of what we're providing, a big chunk of what we do is cost segregation, but where we fortified is to make sure that no matter what happens, no matter what audit happens, if we get an information data request from the IRS, we have all the information ready to go. So what I would tell all your listeners, if they're using us or they're using somebody else, it all starts with the value of your land and how you're looking at the value of the land. You want to make sure you associate a land value that provides maximum defensibility, but also the most opportunity for depreciation with the personal property that you have. What we've seen in audits is that is the first question that they ask. So somebody does a cost segregation, it gets picked up for audit, they're going to say, show me your land value. The key thing with land value is doing an allocation based on the value and not using the value itself and proving that out. If you are not doing that, if you can't satisfy the letter of the law for that allocation, the cost segregation is thrown out. So a big part of what we do before we ever do any engagement is we figure out what the land value is. Either that's in coordination with the CPA or through third-party resources incorporated in the statute or the reg that the IRS does dictate and how they want land value to go. So we do look at land value. It's a big process that we have to undertake. It does cost money. There's no way to automate it because, as everybody on this podcast know, John, I'm sure you're very aware, the value of land is the most subjective valuation in human existence. So being uniform is key. But with that, the next thing I would say is something called partial asset dispositioning. So if you haven't heard of partial asset dispositioning, and this specifically ties into multifamily, usually when you do a cost segregation, you're totally focused on personal property. Where's my 5-year? Where's my 7-year? Where's my 15-year? Forget about the 39 and 27.5-year assets. For multifamily, they start at 27.5-year. But some of those are really, really big ticket items, like your roof, your AC. These things are not eligible for cost segregation, but oftentimes if you're buying something that requires rehab or a lot of improvements, those items are being replaced. And I am seeing this missed left and right because it looks like more work. So why do it if I'm already producing $1 million in savings? Here's another $400,000. Why would I waste my time? So what happens in partial asset dispositions is when you do a cost segregation, you're taking assets and you are putting them into different buckets, the 1245 and 1250, like we talked about. This 1250 property over here, typically you think there's not much there, but the way it looks on a tax schedule or a depreciation schedule is, let's say I buy a multifamily unit, $1 million. It shows up as $1 million with a life of 27.5. And then let's say I even do a cost segregation. What happens to the schedule is it still stays here, $1 million. It pulls out the land and it pulls out the 5, 7, and 15-year assets. But now let's say I need to buy a new roof. Let's say I need to buy new air conditioning units. What happens is that depreciation schedule shows those new units. It says new AC, new roof, $200,000, $80,000. The reality is the original purchase price still has the old roof on it, still has the old AC units on it. Those need to be valued and expensed. That means they are gone for forever, permanently. That's why it's referred to a partial asset disposition. It starts off as a whole asset that you need to partially remove, provide a value to, and then expense that amount, delivering permanent savings. It's often missed. It's best done in combination with the cost segregation.
Chris, a couple things there. One, fascinating stuff. We might be in the deep end at this point, so hopefully we didn't lose anybody. But these are the strategies where, again, if some of this is over your head, this is why you get somebody like Chris on your team, right? You want to get somebody who understands this stuff, the ins and outs. I'm not that guy myself, but it's great to have these people. I need enough of it to know what to look for and the questions to ask. But I'm not trying to sit there and read the code for 1245 exchanges by any means. Like, that's something, I'm happy that you've got your degrees and all that good stuff to learn it. But there are a couple things I want to make sure our listeners take away. The first is this: we got to find the right people on our team. And you talked about, CPAs, and, a lot of them are retiring and it's harder to find people. And a lot of times these people are busy. I remember a couple of years ago, almost everyone I knew, we were all late on our tax returns because every CPA that I knew from, here in Cincinnati where I am, my folks in Chicago, my folks in Texas, my folks in North Carolina, all of my partners all across the country, every CPA that we came in contact with was just busy. They were overwhelmed, and it pushed everyone's tax returns back. And that was kind of the first sign that I saw that, oh, wow, there's something with this industry where we're not getting maybe the service or the speed that we were accustomed to receiving. And I also noticed that we're not having these level of strategy conversations on a regular basis with our team, with our CPAs. And I don't think most investors are. So how do we ensure that we have the right people on our team who are giving us this level of advice so that we're making the right decisions and saving the tens of thousands of dollars, if not the hundreds of thousands of dollars, when it comes to our tax obligation?
That's a very astute observation, because it's completely accurate. And I would say just a few years ago, getting that first canary in the coal mine, it's only gotten worse. The ability to provide quality service, and then to find a CPA who knows real estate. There's a couple of them out there
and
that
knows real estate, not just rentals. Like there's some folks who, I've done tax returns for a guy who owns 5 rentals, but the stuff you and I are talking about right here, this is next level stuff. And not every CPA, I mean, my guess is most CPAs probably don't know this stuff.
There's a major shortage, because the things you're thinking, when you start talking about syndication and other things like that, that's where you need to have somebody. Yes, I don't just know how to take a rental property and file a return and take accelerated depreciation or even straight line depreciation on it. You need somebody to tell you what's going to be in your best interest based on how you're structured, or maybe even how you should be structured. And there are what you've seen is there's groups of CPAs, and what I've been most impressed by, there's one who we're talking to today. I mean, this guy who started this firm that's now, multi-million-dollar firm. They got 120 people. He's only like 36 years old, and he's got all these CPAs, and he is the real estate CPA. He's like, this is what I do, and he puts content out there, John, kind of like what you're putting out there. When you see that kind of stuff, when you see a proactive desire to help investors, and not just help somebody who's got $1 billion portfolio, help somebody who does have 5 rentals or is 3 to 4 multifamily units. Those people, if you want to find them, you have to go screen for them. You have to look for them. And then I would almost interview them versus have them interview you. But you got to be strategic about it, because they are in the pole position here. We do need them more than they need us. But it's almost like it's an interview, like a date, not like a job. You want to see, is this somebody I could work with? And then give them a few examples, and also see if they have examples listed. It's not that hard to create a website and put use cases up there, to post stuff. You're just catching up with the world at that point in time. So I would screen them as if they were a company that you are going to buy, because they are going to be one of the most important extensions of your team. And one of the biggest reasons to get into real estate is tax. And so if that is somehow falling short along the way, or There's opportunity costs within there that aren't being captured because you're just not getting the best advice. Sometimes you don't even know it could be better. But I would say always explore it. And then even though it is flipped in terms of the numbers, I would reevaluate it every year because it is easy to switch.
I love that, Chris. And I think it's really important because, one, getting someone who understands real estate and the complexity of real estate, not just being a landlord, but commercial real estate in particular, syndications. If you're investing in syndication deals, you want someone who knows that landscape. And that's a part of what they do on a day-to-day basis, because they're going to know the rules, the laws, the provisions, and everything you can take advantage of to optimize your cash flow and optimize your tax situation. That's critical. And I love your point about interviewing them, right? Building that relationship. You're almost interviewing them as a company or as a partner, but recognize if they're good, then they've got options too, right? They've got maybe a waiting list of clients, or the way they work may be a little bit different. And that's something you got to make sure that you're comfortable with. But ultimately, you want someone who's going to be able to help you with these savings because they're the expert. And that's why you bring them on. Me and my wife, we joke about this because, one of the things that they make you do is when you sign your tax returns is you got to look over it and make sure everything is right. And I'm like, this might be the dumbest thing I've ever seen. Like, that's like me going to the doctor and then the doctor give me a report saying, all right, man, hey, look at all that and make sure it's right. Dude, you're the doctor. I don't know. Like, you ran these tests. I don't know what these charts mean. So,
Right.
They give you this tax return with all this legal jargon, and you're supposed to sign it so that they can say, hey, man, if you said it was right. It's like, dude, I don't know what half this stuff means. So I just always find that crazy. Like, this is the only profession I see where someone's like, hey, take this thing that I know you don't fully understand with all these lines and it's a 100-page document and go ahead and sign and make sure it's right. So I don't have any accountability for this. So anyway, it's a little crazy thing that we joke about on our side. I'm like, okay, this is how this goes, huh?
Well, I think you're spot on with that comment because it is very much like that. That way, knowing that that's what they're going to all kind of pigeonhole into, you got to really have a lot of trust with this person. So my other piece that I was going to say, and it does remind me of the doctor, but I found with good doctors, which are also challenging to find, is the exact same problem with CPAs, is you want an expert, but you don't want to know it all. Like, I would say the other thing is you want somebody who's open.
You got to say that twice, man. That's a good one.
Yeah, I think I'm going to trademark that. Actually, just came up with it now. You want an expert, you don't want to know it all, and know-it-alls are closed off. And I feel like, given we work with so many CPAs, I found the really, really good CPAs know more than the others, but they don't act like they do. And if they come across a new concept, they are super open to exploring it. And I think bad doctors, bad CPAs are completely closed off to new ideas, even though they're in an environment, not doctors, but CPAs, where the law changes, I don't know, every 4 years, substantially. So yeah, that should be part of the screening process. And, from what I've seen in recruiting, what I've found works best is asking them behavioral questions based on specific examples. Tell me about a time when you had a client who had multifamily units that had this and this and this. How did you approach that? What was the outcome? How did you tell them about it? Anyway, did they disagree with you? What did you do? Those are the kind of things, how you respond matters. And that's the kind of people I like to work with.
No, that's great stuff, Chris, right? You're talking about how do we ask better questions, vetting these individuals to get them on our team, because at the end of the day, we can do research. We can listen to conversations like this. You heard the disclaimer at the beginning of this podcast episode. This is not legal advice. This is not tax advice. These are just ideas and strategies. If you want to move forward with any of these, you got to go find somebody who is licensed and educated and savvy enough to help you navigate the nuances of this landscape. And you want someone who actually does know it. I mean, if you bring this to them and it's the first time they're hearing about it, that's probably not a good sign. So making sure that you have the right people on your team is absolutely critical. So ask those better questions. Make sure that they are grounded in real estate and understand exactly the best strategies that you could tap into. Chris, the other thing I was going to ask you about is, as you think about how you're helping your clients, we've talked about cost segregation. We've talked about the 1245 exchanges. What are some other kind of big misses that real estate investors have and you wish more people knew about these different strategies?
Sure. So, and also in addition to the partial asset disposition, but it's buying the property, especially in commercial real estate, is sometimes the first step. Everything that's getting bought after that to go into the property also has eligibility for deduction and tax opportunity. And now the bonus is back 100%. That should factor into the equation. I think oftentimes it doesn't. Typically, things like accelerated depreciation, 1245 exchanges, they're done post fact. You have enough information to plan for using these things to improve your financing situation, to get more leverage if you needed it. And that's where one of the big misses, I think, we're going back to the CPA piece and having a good CPA, planning for these things before they happen. So within that, specifically on improvements, you could obviously plan for a cost segregation even before you buy a property. You could plan for a 1245 exchange before you sell a property. But when you start budgeting, I need to build out, I need to change the entire makeup of the inside of this multifamily unit with crown molding, all kinds of other stuff. What amount am I going to be able to accelerate depreciation on? Because I'm spending money now, but this money I'm spending, I'm going to be able to segregate and deduct immediately. That's where I would say we're also providing the most guidance. So it can be proactive versus reactive. If you're doing it at the start of the year, you don't get the benefit until you file later on and didn't plan accordingly, then you will essentially be under-levered when you could have levered more. I think incorporating these tax strategies into the financial planning strategies with real estate investors will help them be able to, number one, buy more real estate, get better return on that real estate, but also improve it quicker without having to go through the bank as much as, well, maybe they like going to the bank, but without having to go to the bank less, or having more of a strong case to the bank to request more money to do the things that you want to do. Because I talked about risk-free rates earlier. You're a real estate investor because you are destroying the risk-free rate. All this cash that you get would all be net positive of that risk-free rate. So the more and more you can plan for having it, the more and more you can get a return on it.
Yeah, great stuff there, Chris. Let's transition just a little bit, right? So you mentioned earlier, 100% bonus depreciation is back due to the passing of the One Big Beautiful Bill Act. And with that said, there's a lot in there that, talks about the economy as a whole, specific things to real estate investors. As you review a document like that and understand the implications that exist for real estate investors, what are some other things outside of bonus depreciation that stand out to you that we should be mindful of?
Sure. So for real estate investors, 100% bonus will be probably the biggest one. But for those of you who did rely on energy efficiency, 179D and 45L, 179D is a deduction. For the most part, it's for new construction build, multifamilies, 4 stories and up. That's going away. After anything being construction starting before June 30th, you'll no longer be able to get that deduction. So since that's going away, it's kind of been like one of those going out of business sales where everybody wants to do 179D all of a sudden. Reality is you still have eligibility for 179D if you've built something in the past. So that change is something that I would capitalize on right now. What I've seen is, as a result of the Inflation Reduction Act, the amount of things needed to perform a 179D and the amount of certifications needed were pretty extensive. So everybody who went and got those certifications, these are all professional engineers too, they're already looking at this going away and saying, I might not have a job, so it might be tough to, if you are finding these opportunities, find somebody who would actually go walk the property and model it and say, yes, this meets the energy standards. 45L is a tax credit for multifamily investors or multifamily builders, single-family home builders. It was a very, very lucrative credit. Since Inflation Reduction Act, it became very challenging to get. So both of these were I wasn't in the room when they were finalizing the bill, but I imagine these were pay-fors because they look like expensive credits and deductions. But not many people were taking them since the Inflation Reduction Act. That's one. The other one is, and I'm not sure how much your listeners might have application for this, but it's something that I would definitely think about because it's not been talked about a lot. If you do have any real estate investment that touches manufacturing, in the One Big Beautiful Bill, there's basically been a new asset class created called qualified production property. So a lot of multifamily investors, developers it might resonate qualified improvement property, which are the improvements that you make after buying a property that are all eligible for bonus depreciation. That's been around. Qualified production property says if you're building something, and it has to be new because the intent was to beef up domestic manufacturing. If you're building something new and it's manufacturing, all assets that are associated with the manufacturing process, even the real property, even the walls, even the air conditioning that is specifically going towards that part of the building, it is all expensible and not eligible for recapture as long as you hold it for 10 years. So the application to that might be if I build a $10 million manufacturing facility, and through a study, it's $7.5 million of it is specifically tied to the manufacturing process. $2.5 million is, call it, offices and storage. You would segregate, do a traditional cost segregation on the $2.5 million, but the other $7.5 million is no longer part of your basis. It's gone, not taxable. So you as a manufacturer stand to get a huge tax benefit. So those are two items that I would say, are going to have the most impact for real estate investors. But the other thing I'll say that if your CPA doesn't talk to you about it as much is when there is a new law, this is what always happens. It happened with the Inflation Reduction Act too, is legislators say, here's the new law. And then the IRS is the one who has to enforce it and track it. And then the IRS is like, wait a second, what does this say? What does this say? And so what happens is every 3 months we get guidance. So on QPP, qualified production property specifically, we know we need guidance because the manufacturing process is not defined. And it's very tough for somebody to say, well, what is manufacturing? I'm making a cheeseburger. Anyway, that's the thing that I think, while it has passed, there are certain things that we know black and white. We know what to do because we've seen it before. There's a lot of stuff in there that we're going to see guidance on come out month to month to month as we begin to navigate this new tax law.
And your point there is that this is something that will take a little bit of time to get that guidance from the IRS since these laws have passed. But ultimately, that new asset class, this qualified production property, it's got some really attractive benefits where the portion that's used for production that you can go ahead and write off separately from a cost segregation standpoint, because that's not going to be part of your basis. The walls, everything, not just the equipment, but like the walls, the flooring, everything, it goes into that pie. And if you hold it for 10 years, there's no recapture on that component. And then I imagine this is, like you said, it's meant to promote more production here in the U.S. and it's given those investors a reason to build more production facilities. But I also imagine that this could be something where maybe it's just a real estate investor and maybe you're leasing that space versus you being kind of the whole owner of the production facility as well. So there's probably a lot of nuance there with who gets what, and you probably have to get someone to move in and actually start production. So I'm sure there's a lot more questions involved, but to your point, definitely something to keep your eye on if this is a space that you're interested in. It kind of takes the industrial space to a different level, right? You probably start to niche down a little bit even more in what industrial is and where you want to focus on the industrial landscape.
Absolutely. And I will say on that one too, there is a lot of if-thens based on ownership and whether or not the building's new, whether or not the equipment's new, what you're retrofitting with. But yes, it is something to look at. And I think bonus is just hogging the headline. QPP is going to make a big deal for people who do own real property that is tied to manufacturing.
Yeah, Chris, great stuff, man. Last question here is opportunity zones. What's the latest with that?
So opportunity zones is not really something we do a lot of. I know they are incredibly lucrative. They're always being rezoned and identified, and some of them are maturing out of that. But they do produce exceptional tax benefits. It's just not something we do a lot of. So I couldn't provide much new market intel for you, sadly.
Well, there you go. Good to hear. Well, listen, lots of information that Bill, so certainly check that out. Get somebody on your team. My big takeaway from our conversation is you better have the right people on your team, right? I mean, that 1245 exchange is a great idea for folks who have a good basis. If you've done that cost segregation, this is a way to continue to extend and take advantage of the tax law. It takes a little bit of work, but your team has already done that work. So it's worthwhile to reach out and have that conversation. Chris, for folks that want to learn more, what is the best way for them to get in touch?
Yeah, so the best way to get in touch with us is csap.com. So when you're thinking cost seg 1245 exchange, csap.com is the best place. It's kind of corny, but we're fast. So I say go to CSAP ASAP. But that's where you can find information on us. You can find somebody to reach out to, but also we do have a nice little box in there if you're interested in a cost segregation or a 1245 exchange. We only need a little bit of detail to provide you with a full benefit analysis for those different properties. So happy to support there, but want to make it easy too. CSAP, ASAP.
There you go. Check it out. Chris, great having you on today. Appreciate you coming on and sharing such great insights with us and our listeners. We look forward to staying in touch with you, man. Have a great rest of your day.